Assalamualaikum and good day everyone. My name is Jasmine Jumat and for my part, I will explain about investment risk and return trade-off. First, risk refers to the possibility that the actual return we receive may be different from what we expect. In simple words, the higher the uncertainty, the higher the risk. Return is the future value or profit that we expect to gain from an investment. There are three types of investor. First, risk taker who is willing to accept high risk for the chance of higher returns. Second, a risk-averse investor who prefers low risk and stable returns. Lastly, a risk-neutral investor who is satisfied as long as they get back their principal. The diagram shows that as the risk increases, expected return is also increases. Next, I will explain about total risk. Total risk is caused by factors that create uncertainty in expected returns, and it consists of two types, systematic risk and unsystematic risk. Systematic risk is external and cannot be controlled or avoided. It affects all securities. Examples include market risk, interest rate risk, and purchasing power, which are caused by economic changes, inflation, or political issues. On the other hand, unsystematic risk is internal and controllable. It only affects a specific company and can be reduced through diversification. Examples include business risks such as poor management and financial risk, which comes from high debt level. In conclusion, understanding this risk helps investors make better investment decisions.
Market mechanism is spread into two. The first one is primary market mechanism for raising capital, which company issue new security. In this market, there has 7 chosen methods to use in offering new stock. The first method is initial public offering, which company offer share to the public for the first time. Private or public placement is sale of security directly to institutional investor or accredited individual. Sell share to employee is company offer share to employee, often at discount price or compensation package. Right offering is existing shareholder have right to buy additional share at a discounted price. Bonus issue is company issue additional share to existing shareholder at no cost. The last method is seasonal offering. Company has seasonal capital needs. Another market mechanism is secondary market mechanism of trading, which markets deal with previous security issued by company to investor. Bursa Malaysia use score and win score for trading. Trading operation from Monday to Friday except public holiday. The transaction can be made by cash transaction, merchant trading, and contract transaction. The securities can be ordered by market order and limit order.
I will briefly explain the regulatory roles of Bursa Malaysia and the Securities Commission in managing risk in the securities market. First, Bursa Malaysia. Bursa Malaysia plays an important regulatory role in managing risk in the securities market. First, it strengthens the framework of capital and risk management practices of public listed companies to ensure companies manage their finance properly and avoid excessive risk. Next, monitor the financial condition and operation of listed companies. Third, ensure timely and accurate disclosure of material information so investors receive important information such as financial performance. And lastly, reviews and enforces rules, policy, and guidelines. The second one is Securities Commission. The Securities Commission also plays a key role in managing risk and protecting investors. It supervises exchange, clearinghouses, and central depositors to ensure the overall market system operates smoothly and securely. The Commission also licenses and supervises market participants, such as brokers and fund managers, to ensure they meet legal and professional standards. Furthermore, it encourages self-regulation, where market institutions take responsibility to follow ethical practices. Finally, the Securities Commission ensures proper conduct of market institutions and licensed persons, which help prevent fraud, misconduct, and protect investors' confidence in the capital market. In conclusion, both Bursa Malaysia and the Security Commission play important roles in managing risk and protecting investors in the capital market.
For Chapter 3, investment instruments are matched with different risk profiles. Investment in securities includes treasury bills, bonds, preferred stocks, and common stocks. Treasury bills are suitable for risk-averse investors due to their low risk, while bonds and preferred stocks suit risk-natural investors. Common stocks are more suitable for risk takers because returns depend on market performance. Investment in savings, such as saving accounts and fixed deposits, is suitable for risk-averse investors as the principal and returns are known with certainty. Unit trust funds involve pooling funds from many investors and are managed by professional fund managers. Due to diversification, they carry moderate risk and are suitable for risk-natural investors. Lastly, derivative securities, such as options and futures, involve high volatility and high risk, making them suitable for risk takers. Investors must choose investment instruments that match their risk profile to balance risk and return.
today I will explain investment instruments number 5 until 8, which are real estate, collectibles, gold, and forex, and how they relate to investment risk. First is investment in real estate. This includes houses, land, and condominiums. Real estate is usually considered a moderate risk because its value can increase over time, but it also depends on market conditions and locations. Therefore, it is suitable for risk-natural investors. Next is investment in collectibles such as artwork and old coin. The value of collectibles is uncertain and depends on demand and trends. Because of this uncertainty, collectibles is considered as a high risk and suitable for risk takers. We move on to investment in gold. Gold is often used as a hedge against inflation. Although the prices of gold is fluctuate, it is generally more stable compared to the stocks. Therefore, gold is more suitable for risk-natural investors. Lastly, investment in forex or foreign exchange. This involves trading currencies. Since exchange rate change rapidly, forex is considered as a high risk and it is suitable for risk takers. In conclusion, different investment instruments carry different level of risk. So, investors should choose based on their risk tolerance. That's all from me. Thank you.
Based on Chapter 1, we have learned that understanding systematic and unsystematic risk will help make a better investment decision. In Chapter 2, we also learn how company will raise funds through 7 methods and how Bursa Malaysia deal with security issued by company. Other than that, both Bursa Malaysia and the Security Commission play important role in managing risk and protecting investors in the capital market. From Chapter 3, we also have learned that there are 8 different types of investment instruments and each of the investment instruments carry a different level of risk and return, therefore must be matched with the investor risk profile.